I still think it's possible for Bitcoin to hit 200,000 by the end of the year. But I think it's very bullish for Bitcoin and Ethereum because...
Why?
Well, gold moves first and then Bitcoin catches up. So I think that there is going to be the network value of gold just went up by a lot. And so let's say gold settles at 5,000. That puts fair value of Bitcoin, like 1.6 to 2 million if it matches gold's network value. So I think it's actually helping Bitcoin's future terminal price.
Tom Lee believes a strong Bitcoin scenario is emerging. He notes that throughout history, Bitcoin has behaved similarly to gold, frequently falling behind before spectacularly catching up. A surge in gold indicates that investors are moving away from government-controlled currencies and toward assets that cannot be created or inflated. As the digital equivalent of the concept, Bitcoin typically follows. Lee contends that assuming parity in their functions as stores of value, Bitcoin's fair worth could soar to between $1.6 million and $2 million per coin if gold were to stabilize around $5,000 per ounce. And this isn't just a long-term hypothesis. According to Lee, the circumstances for this next big move are starting to come together, perhaps as early as the fourth quarter. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
Yeah, it's pretty interesting. What about gold? Gold's been on this historic run. Do you think it's real? Do you think it's manipulated? Do you think it can continue?
There's a lot of reasons gold probably is going up. And at Fundstrat, we don't do commodities. I kind of regret not recommending gold because it's been so great. Because, generally, I like to be helping our clients be involved with things that are going up. So I think gold's move is like...
It's a good strategy.
Yeah, exactly. I don't want to fight it. And
what kind of business do you have? I help our clients' portfolios go up.
Yeah. So gold's been amazing. I think what's really stood out is that you can explain gold's move by just pure technicals. Like I was talking to our technician, Mark Newton, yesterday, and he says that gold had a cup and handle pattern that the breakout was July of this year. And so the measured move should have taken it up to where it is now. But let's say price leads fundamentals. I think that July is also the time that the stablecoin industry started printing a lot more creations. And as you know, there's been gold stablecoins and dollar-based stablecoins, but a lot of the dollar-based stablecoin issuers are over-collateralized. So I think the stablecoin industry has been printing a lot of dollars, they're over-collateralized, and I think they've been buying a lot of gold.
Interesting.
So I think that the stablecoin industry has been the newest bid for gold.
More so than even like a China central bank?
Yeah, because they've already been present. The central banks have been present for some time, but there's somebody new buying gold on top of the retail buying gold. And I think that would be my guess, because now there's like 7 or 8 gold stable coins. Plus, there's big stable coin issuers. And so that could be the bid to gold. Now, does that mean gold is unlimited on the upside? I don't know. I'm not studying it, so I don't know. But I think it's very bullish for Bitcoin and Ethereum because...
Why?
Well, gold moves first and then Bitcoin catches up. So I think that there is going to be the network value of gold just went up by a lot. And so let's say gold settles at 5,000. That puts fair value of Bitcoin, like 1.6 to 2 million if it matches gold's network value. So I think it's actually helping Bitcoin's future terminal price. As you know, Bitcoin makes its move in 10 days a year. So are Bitcoin's best days in the fourth quarter? Probably, because we have catalysts, the Fed's easing. We have a shutdown that's been risk off. We have China-US tensions that, look, every time there's a headline on China, like Bitcoin takes a gut punch, right? Because it is money flows and deleveraging. So that goes away. We have seasonality that favors stocks moving up. Stocks moving helps Bitcoin. So to me, the chances of Bitcoin having a huge fourth quarter are really high. And not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year. Most of the crypto people I speak to expect a 4-year cycle. And they're adamant, that maybe Bitcoin peaks early next year. But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle.
But there would still be 50+% drawdowns in the future, or there's a kind of cycle is broken and you get something different?
Yeah, I'm sure there'll be 50% drawdowns because The stock market has more frequent 25% drawdowns. I mean, that's when, even though people realize, I mean, the stock market's made a lot of progress last 6 years, we've had an unusually large number of 25% drawdowns. And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40. I don't really have an idea what the following year looks like until early December, because then we're only 1 month left in the prior market. Because this year, for instance, I think S&P gets to 7,000, right? But if we get to 9,000, then it pulls from next year. So, so price being a little unknown, I think there's a lot to be optimistic about in 2026 because, one, monetary policy is easing, and that's room for mortgage rates to come down. And we know there's a huge pent-up market for not only housing to become more affordable, like through allowing capital to build cheaper homes and stuff, but for people to have relief from mortgages. The ISM, which is the benchmark of manufacturing confidence, has been below 50 for 32 months, the longest stretch in history. But once the Fed starts cutting, companies can get more confident. So the ISMs recover. That's great for the US economy. We know there's onshoring next year. That's GDP activity. And then AI, I think, is becoming, as you just pointed out, like robots, agentic, superintelligence. These are huge innovations coming next year that are good for earnings growth.
Tom Lee takes a step back and considers the wider picture. The globe has experienced numerous crises since 2020, ranging from supply chain disruptions and COVID to uncontrollably high inflation, record-quick rate increases, and geopolitical conflicts. Despite all of this, corporate profits have kept rising. According to Lee, this demonstrates that the current stock market is battle-tested and not at all weak. Under tremendous stress, it has learned to adapt, endure, and even flourish. He contends that this robustness encourages higher rather than lower valuations. Additionally, Lee feels that the market now merits a structurally higher price to earnings ratio than in the past, because a large portion of today's earnings come from steady, recurring income firms rather than traditional cyclical industries. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
Feels like it dominates the company fundamentals.
Yeah, that's true. But in that 6 year period since COVID, earnings delivery has been amazing.
So substance has been there.
Yeah. So like even this quarter, 85% of companies are beating results right now. And it's still going to result in basically 15% earnings growth. I mean, so that's not late cycle earnings growth. Late cycle would be single digits. So companies are still finding ways to grow margins and earnings. And there's plenty of multiple expansion. I mean, financials, business results look more like tech companies now, but they still trade like financials. So I think there's a lot of groups that can re-rate. One of the best measures of large investor sentiment is the AAII Net Bulls Index, bulls less bears, because it's been run for 40 years. This year, it's averaged minus 11.7. So every week, the weeks through this year. There's only 3 other times in the last 40 years it's registered negative 11.7. 1990 or more, 1990, 2008, and 2022. All were bear market years. So sentiment reads as if we're in a bear market and the market's up 15% year to date. Why is it the most hated? I think we show this in our research that it's based on political divide. So the country is 50-50 Republican Democratic. But in the stock market world, and there's Pew Research data on this, 57% of professional money managers are Democratic. 66% of hedge funds are Democratic, and something like 69% of venture capital funds are Democratic.
Interesting.
So the risk capital world didn't vote for Trump. So they view his policies as that of someone who is destabilizing to the economy. In the bond market, it flips. 80% of credit managers are Republican. So that's why this year the bond market hasn't been, high yield spreads have been stable, credit spreads have been stable, but the stock market's been volatile. And you can see it maybe in the economic commentary this year. How many economists have said, oh, tariffs are going to cause a recession, or tariffs are going to cause an inflation surge? That is actually a very subjective argument, because tariffs are a tax. And if we treat it as a tax, taxes are not inflationary. So we'd never say it's inflationary. But the economists who are portraying it as inflation are I think they're taking a specific view that makes it an inflation argument. So in other words, there's some sort of bias in that statement. And also people are willfully overlooking that valuations are actually, they're dynamic. From 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%. It's at 25 PE. I mean, the bond market's expensive. So, so I think you're correct.
Tom Lee considers the stock markets and corporate America's unexpected resilience in the face of years of unrest. He notes that despite numerous black swan occurrences such as the pandemic, supply chain disruption, inflation surges, and the Fed's quickest rate hikes in history, businesses have continuously produced outstanding earnings growth over the last 6 years. Lee claims that over 85% of businesses are exceeding forecasts only this quarter, with 15% earnings growth, which is much below what would often be seen as late cycle weakness. Lee draws attention to a more profound aspect of investors' personal development. He points out that many conventional Wall Street personalities continue to undervalue cryptocurrencies and Bitcoin because they think their owners are unprepared for actual market downturns. However, as Lee notes, cryptocurrency investors have previously weathered several 80% falls, which has given them a certain kind of strategic and emotional fortitude. He further notes that some of the strongest equities traders he has encountered are from the cryptocurrency space, having gained emotional control and keen intuition from enduring such unstable environments. In the end, Lee concludes that hardship has helped investors and the market grow, while a new generation of investors molded by the harsh volatility of cryptocurrency has learned to prosper in uncertainty. The stock market has withstood crises and emerged stronger. When taken as a whole, they show a financial environment that is more flexible, transparent, and dynamic than it has ever been. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.